Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the show. I'm Victor McClure.
Coming from the Star, I'm Guy Allard.
That's right. Yeah, for those of you that haven't heard our show before, we're headquartered at the Dallas Cowboy headquarters of Star in Frisco. It still shocks me to this day that they were trying to sell me land along this area up here 20-something years ago. And I said, this town has nothing. They got they got one restaurant, one grocery store, and like four establishments that massage parlors. So I was like, really? I go, how is this going to become a city? And look at it now.
Just want to make one thing perfectly clear. Just because we're coming from the Star, I assure you, I guarantee you, I promise you, we will never kneel during the show.
No, that's true. They quit airing that stuff.
Don't know what to say after that, do you?
They quit airing that stuff.
I quit watching them. So you told me, right? They didn't broadcast the national anthem anymore?
No. There's only 4 or 5 teams still doing it.
And I will tell you, quite frankly, it was painful not to watch. Many times I wanted to watch, but I'm willing to make those sacrifices.
That's why I'm
to make our country great again.
Anti-Pete Carroll and anti-Seattle. They're the biggest ones. They're the biggest kneelers.
I agree with you on that, but I did like Pete Carroll. Yeah. I will tell you, my Hollywood Star can't watch list is getting really long. I was watching one the other day, and one of them, Matt Damon, popped up. Oh, turn it off. I can't watch it anymore.
You're not going to ever be able to watch a movie again.
I know it. It's terrible.
You can't bring your entertainment into politics because it will not work.
I'm waiting for those Hollywood elites to start calling me and say, oh, please come back.
Yeah.
You're hurting our revenue.
That's right. You're showing them.
I only made $80 million this year.
I don't know what to do.
Please watch our movies. You think they'll call?
No.
Oh, well, there you go.
Like I said, and also the NFL franchise with the cheapest one, period, being worth about $2 billion. I don't think they care either.
I was thinking about that the other day. Just, you know how we are about numbers all the time. Just trying to put numbers to it. The Cowboys are worth $3 billion. Is that a fair?
$4 billion. I think it's 4.5.
All right, call it $4 billion just for math. And revenues or viewership went down 20%. You realize what 20% of $4 billion is? $800 million. That's a lot. Now, I know the franchise doesn't lose 20%.
Right.
And I know the revenues aren't $4 billion a year, but still, 20%.
A lot of those seats are pre-sold. So.
Yeah.
And remember, the networks are what paid those giant 10-year contracts. Just because the networks are losing money doesn't mean the same revenues coming into the NFL.
No, I know. And
they can lose their revenue other ways, I'm sure. But
how about those people that have morals and stand up for something and stick to it? Like, let's say the president of Papa John's.
Yeah.
No longer CEO, is he? What happened there?
I don't know. I always wonder that, how you own most of the shares and you founded it and now you're out. I'm like, how do they do that? Maybe he didn't own most of the shares. Maybe he went public and gave up more than
Board of directors, right? Sold more than he had. He must have. He couldn't have 51%, or he could have voted himself in.
But I've seen that before. Who's the...
They have a big voting block.
Was it the Tesla guy or whatever get voted out of his own company?
Elon, was it? No.
There was something like it. It was some big deal.
It could be. I'm just saying, no, I can't imagine.
Because, we obviously aren't Tesla or any of that other stuff, but I don't think anybody's going to vote me out of here.
We were having lunch today, and Victor was telling me about, who was the coach that we were talking about? Gruden, yeah. That why would he take a job after he had a relatively, you would think, easy job as a sportscaster? And I'm saying, they only make make 500,000 to a couple million a year. And said, oh no, he made yada yada yada. We looked it up, $6.5 million, highest paid sportscaster on the planet. Are you kidding me? To give that up for a grueling, stressful job as a
90 hours
a week, coaching 80 kids that really don't care what you say because they know it all. What's he thinking?
I know. I'd take the easy job, I think.
Well, it was only $10 million a year versus $6.5. I mean, I get it. It's a 50% increase, but
yeah, the truth is, he really wanted to coach.
And I couldn't believe that there was a sportscaster. Why is there such a discrepancy? Terry Bradshaw made $11 million for 5 years, which is what, 2.2 a year, and he's got to be every bit as good as Gruden, if not better. No,
Well, Matt Lauer, I think, made like 20, 30 million.
Well, yeah, but he's that's a different category, though, right? Oh, speaking of which, remember when he displaced Ann Curry or didn't somehow let her progress into the chair? I just saw a little brief snippet of her a few days ago. And they were asking her, well, do you think it's true about Matt? And she goes, well, I had my suspicions. But she was nice overall. But, yeah.
No, I know. And so what we're doing today, let's talk about we've talked about our retirement planning, stuff like that. First off, by the way, in the show, we're going to talk about we talked about the new tax laws and a couple things. We'll briefly go over that because I've already talked about it twice this year. But
let's make a show out of it.
There's Social Security and Medicare changes for 2018 that we haven't talked about, and everybody needs to be aware of it that isn't. But first thing, remember our philosophy here, okay? It has been and always will be, is
stand for something or you'll fall for anything, right?
That's right. Well, think about it. If you need $10,000 a month in expenses, you're going to retire in 5 years. Well, why don't you buy $10,000 a month coming in? No matter what happens to the stock market, no matter what happens to bonds, whatever, you got $10,000 a month coming in. That leaves you the freedom to put as much as you want of the rest in the stock market or whatever. But you're guaranteed your retirement. I don't understand. Sometimes it confuses me how somebody would consider a non-guaranteed retirement versus a guaranteed retirement.
I've thought about that. I think I have the answer, or at least partial answer for a part of the people. You can guarantee them right now if they take X amount, usually not all their money, right? Just a portion. They could guarantee themselves $10,000 a month if that's what they need, if they take this off the table. Well, number one, other than having to take the money off, I know they believe in their hearts that if they keep it there, they may get $15,000 a month instead of 10.
Right.
And they want that carrot that's in front of them of possibly getting 15 or 20,000 a month. Why would I guarantee myself 10? I only need 8.
Right.
But I may get 15. Are you crazy?
The fear of missing out is a big one.
Yeah.
That's why we've done plans for people right now that got 80%, 90% of the market, and it's done fantastic. My market piece has done fantastic. My managed accounts have done great. All of that's great. But still, you have to look at, hey, you've already won the race. If you've saved enough to a certain point and you know you can secure your retirement, you need to seriously consider it. But our plans are different than every other plan you might get from Fidelity or Merrill Lynch or anything else. Much different. I've got the most comprehensive software that I know for retirement planning. It takes into account taxes. The new tax law has already been updated. Taxes, inflation. If you think your Medicare is going to go down over the next 20 years, you're nuts, or your electric bill, your water bill, or maybe groceries are going to cost you 50% less. They're all going to cost you more, and you have to account for all of that. And some of these programs account for that. They'll account for inflation. They'll assume a certain inflation. But there's a few things people are doing or relying on in their retirement planning, and this is why I think everybody should take advantage of the no-cost, no-obligation retirement plan that we're offering and Social Security Optimizer. Is because they do it based on the 4% rule, okay? They do it based on average market returns. They do it on Monte Carlo simulations.
Right.
And we'll talk about those a little bit and tell you what they don't do. Because what happens is the Monte Carlo simulation is basically taking the averages of a market if you've got 80% stocks versus 20% stocks or 20% stocks versus 80% fixed income. And gives you the probabilities of success.
Based on 1,000 different scenarios.
Like
and
a
you
million
see all the
scenarios.
lines on one page.
You'll see a million lines of
Right.
Like, look at this. It gives me an 80% chance of success.
Probability, not guarantee.
Right, just staying with what I'm doing. What that ignores, what every Monte Carlo ignores, is a sequence of returns risk. If you let's say you're a pro market person. You're 100% in the stock market. That's going to cover everything you got, except for your cash stuff for emergency.
Sure.
All right? And the sequence of return rates, if you get lower returns or negative returns in your first, say, 5 or 10 years of retirement, it's almost impossible to recover. Almost impossible. Think of a simple math problem. You got $1 million, you want to take out $50,000 a year. Okay? Market drops 50% like it has twice in the last 18 years. Now you got 450, right? You're 500, which
with
you
the
lost.
first 50%
That's right.
with drop.
So the next year, let's say it makes 20% 3 years in a row, that's pretty strong, right? Because the rebound might be faster than
When you
the
make
drop.
450, you take 50, now it's 400.
That's right. and you're making 20% of 4, and you're at 480, right?
Right. Take 50, you're at 430.
That's right. So you do it the next year, you lose 50, you're at 500 something. It's impossible. It's a death trap. There is no way you can come back if you're taking money out of a losing position.
And that's the easy layman's way of saying sequence of returns. What that means basically is if you need to withdraw from your account annually to live off of, right, then those Monte Carlo situations aren't taking that into account.
And how do you combat a sequence of returns risk? It is combated the only way it's effectively combated is to get income that is not direct, that cannot go down. In other words, the income can't go down, the principal can't go down.
Now, everyone on the planet will tell you that is an economic professor, or we've talked about these Nobel Economic Prize winners. They will all tell you that. The only one that won't tell you that is Ken Fisher. And the problem I find in talking with a lot of people, Ken Fisher, or these people that are more pro-stocks and anti-annuities, you hear them, they spend so much money weekly and monthly telling you that, oh, never do that, you need to do stocks all the time, that not only do you hear them say that, but if you look at a serious annuity and it makes sense, and then you ask one of your friends or 2 or 3 of your friends, well, guess what? They've heard these guys on the radio all week, all month as well. And the first thing they say, and they may not even know why, is, oh, no, I've heard you don't want to do that. Well, they say not to do that. Well, who is they? I always ask my wife, says, oh, well, they say that's, well, who is they? So it's all based on this marketing, and the marketing snowballs kind of against making good decisions because it's not something a particular group does that's paying for all the marketing.
Well, Doug, annuities aren't for everybody by any stretch. Anybody says they are.
No, but for guaranteeing income and locking that part in,
they just pay
as
more
of
income.
Today, there's nothing better.
So that's what you've got is, it's not for everybody, but it's just somebody selling a competing product. Anybody tells you that a legitimate investment is terrible is not giving you all the facts. Some of them are terrible. There's no question. Some variable
but they're not legitimate.
Terrible.
You don't preface it with a legitimate investment.
But see, remember, you got to have income coming out of a principal that doesn't fluctuate. What can you do that with? A CD does that. A bond, if it's AAA, blah, 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 to term. And a fixed annuity or a money market. Those are the only things that do it, that are going to guarantee, well, now some people will say, well, dividend stock. No, dividend stocks, that dividend can fluctuate wildly and go away.
And has.
And it'll drop.
And that's been the trend.
That's right. And then what you've got is 10-year bonds are paying 3%, 5-year CDs are paying 1%, money market's nothing, right? 0.1 if you're lucky. They just pay more. So right now in this economic condition that we're currently in and have been in for the last 15, 20 years, the annuities pay more. So I can put less to create the income stream. You can still create that income stream with a non-annuity approach. It's just going to cost you more. That's just the way it is. In other words, it's going to cost me $500,000 to produce this $40,000 income with an annuity. It's going to cost me $1.25 million in a stock portfolio if I'm adhering to the 4% rule. If I'm adhering to a CD, it's going to cost me $4 million in a CD. So do you want to do $500,000, 1.25, or $4 million bucks to produce the exact same $40,000 a year? So that's the reason you'll hear us talk about that stuff. But a typical Monte Carlo simulation does not account for that. But it looks, I'm telling you, some of them say 1 million different entry and exit points in another market, and they can't effectively account for that because you do that simple math problem I did 5 minutes ago. If you lose a strong amount within the first 5 to 10 years, or don't make enough in that first 5 to 10 years, it is almost impossible to recover. Also, in comparison to the written retirement plan we offer, we don't use market returns. I had another client here this week that said, you don't understand. It had Monte Carlo simulation. It was on the internet. I did the whole thing.
Right.
And it said, I've got a 90% probability of success. And I said, what's it based on? He goes, well, average market returns. I go, okay. The average market return with stocks, about 10%. He goes, but I'm assuming like 6 or 7. I'm just letting you know. So I gave it a little leeway. I go, okay, but the calculator was assuming average market. I said, all right. Well, the last 18 years, the market's made 5.25.
If you paid no fees.
No fees, 100% of the market, which
no cost.
Not even 10% of people on the planet do this, make as much, right? So it's made 5, and that was 4 until this 20% year last year. So you're completely ignoring this century You're completely ignoring the first 18 years to come up with, I'm going to make 10% forever. Times might have changed. Because remember, in the old days, half of the gain of the S&P was dividends. Half of it. You never had more than a 4 or 5% capital gain. Then you had a 4 or 5% dividend. But that's switched. So now, dividends might be 1.5%, 1.8. If you're getting that same 5, you only might be making 6 or 7 if you're lucky. And we didn't make that. We made 5. So those average returns don't work. Now, let me tell you this. The actual market made 5.25. You know what the average return was? 7.74.
On the same numbers.
Yeah, same exact numbers.
It's just a different terminology.
Because when you take an average, you assume a constant principal.
That's right.
Which is impossible. If you take an actual return, you'll say, okay, how much would you make? In other words, I got $100,000. If I had 5 a year for this, I'd have
compounded,
this X number.
Right.
That's the real return was 5, even though it looks like you averaged 7.74. That's why Monte Carlo simulations don't work. They don't give you enough information. Because if you take, I'm going to average for the rest of my life 10%.
Life's good.
That's a hope. That's not a plan.
No, and
we need to stress test your portfolio.
We talk about it all the time. A couple of real important points if you can draw from this conversation. One, very important to get a plan so that you know and you're not guessing. We're very good at that. We can certainly help you do that with no obligation. The second thing, which we pride ourselves on, is using realistic numbers. Like Victor just went through, the whole purpose of that exercise was you can't use 10%. If you use 10%, life is really, you'll be fine. You got to use a real number, and then you want to stress test it to get yourself closer in. And once you've got the plan and it's defined and it's something that's guaranteed, which, we use a good portion of guarantee, and then there's some for inflation and that sort of thing, and it works for you, you have to work the plan. You have to stick with it. How many of you have friends out there, Victor and I can think of a couple, that they take their jobs that way? They'll do something and it doesn't get them there quick enough, so they quit and they try something else and they try that. And now there's things that happen in life, I understand, but these are guys that they're always looking and switching for the better thing. We see a lot of people come to us that way with investments. Oh, I only made 7% last year. The market made 9%. There's been people that we wouldn't take because they're just jumping around from one thing to the next all the time, and probably because they don't have a plan or they didn't believe in their plan enough to stick with the plan. So number one, get a plan. Number two, use realistic numbers. Don't go to the guy that just gives you the best answers because he's using a higher number for your average. And three, stay the course. You'll get to where you need to go.
Some advisors use the high returns for a reason. It looks great. Yeah, I go, if you got a $3 million portfolio, make 10% a year, and you're only spending $100,000, it's going to look fantastic. Oh my gosh, you're going to be so rich.
The heirs are going to be happy.
That's right. But that is telling you what you want to hear. You want somebody to tell you the truth. Because remember, that 5.25% of the market's made with dividends the last 18 years is not what people made.
It's unattainable.
They made about 50, 60% of that on average. Less than 10% of advisors made that actual 5.25. And what happened is when the market goes up 8 years in a row, we forget it. Because, no, I made much more than that. I just made 20. I go, yeah, you just made 20. Last year the market made like 2. The year before that it made like 4. But if you add them all together, it came out 5.25. So what would I do? Can you use 5? Well, 5 people they haven't got that this century. Okay, well, should I lose half of that, what they actually got? Maybe.
If you're not withdrawing from the account, correct?
That's right.
If you're withdrawing from the account, you can't use 5.
Right, that's right. And so that's why you need a real retirement plan and a real stress test to show you, hey, if the market doesn't cooperate exactly like I want, am I eating cat food when I'm 80? Just call us, and we'd be more than happy to go over the details of that or to start a plan for you. 972-715-2424. Again, 972-715-2424. Or you can always go to ilovemyretirement.com. All right, let's talk about, we've already talked about the tax law changes. What's it called? Tax Cuts and Jobs Act, right? Isn't that what it's called? Something like that.
Okay.
Pass-throughs. This was a disappointment for me since I own a pass-through business. It was supposed to be a lot lower tax bracket, and they gave you the first 20% you can write off.
Oh, this is only the first phase.
That's right.
They're going to do several.
20%, unless you have income of like over $300,000 or something like. Well, that's not a tax cut at all. Now, big corporations got a huge one, right? We know that.
And apparently, a few of them seem to be doing some good things with it.
Absolutely. We talked about now there's They got away the individual deductions. I think it was $4,200, $4,300 a person, but they doubled your standard deduction. So now it's what, $12,000 a piece or $24,000 for a couple. A lot less people are going to be itemizing right now. Roth conversions, remember,
We're going to be able to do our taxes on a postcard, right?
Yeah. That's right. From now on, you cannot reconvert. If you convert to a Roth, you can't go backwards. You can still do last year's up to October of this year. There's one thing that a lot of people missed. Oh, by the way, and the estate tax went from $5.5 million a person to 11. So if you're a married couple and want to leave something to your heirs, estate tax only counts after $22 million. Okay. Now, advisory fees. Here's kind of an unintended consequence. They started getting rid of a lot of miscellaneous deductions. One of them was your tax preparation. It is no longer, you can't write off how much you pay your accountant. So what I need to do is really
or H&R premium, block premium like I use.
I need to go to my accountant and renegotiate my rate, I think. What do you think?
Absolutely.
So I can't write it off. But also investment advisory fees. We're like everybody else. You know, we charge 1% a year on a managed account. You know, you could write that off. You can't write it off anymore. You could always write it off advisory fees. Now, for some people, believe it or not, I know this sounds crazy, but commissions make more sense. Remember the whole thing was away from commissions, now it might make more.
Right.
The reason my commissions will make sense, let's say you had a 2% to buy something and then 2% to sell it, right? And you had a 10% capital gain.
Right.
Well, since you had to pay commission in it, you only have a 6% capital gain.
4%.
And you can't write off any of the fees you've been paying. Let's say it was 1% for that 5 or 6, 10 years or whatever. None of those can be written off anymore. And so I thought that was kind of interesting that some of the unintended consequences are you can't do it. Another thing was they lowered it was 10% of your adjusted gross income. If you have more net medical expenses, you can write them off.
Correct.
They moved it back to 7.5 for this year and next year. It goes back to 10 in 2019, I believe. All right. Everything else is pretty similar. The Social Security, though, and Medicare are making some changes. We haven't had too many changes in Social Security for a while. But they're getting a 2% increase. See, that's a woo, right?
Yeah. Where are they taking it?
They're going to take it back in Medicare B premiums.
There it is.
So they're going to raise the average person about $46, about 2% in the average check, right? But they're going to, so $46 raise.
Right.
The average person is going to raise Medicare Part B $25 a month. So there's a little more than half of
we're up 20.
The gain. Then you got your Medicare surcharge for people that make higher incomes. Okay, they pay for Medicare Part B $187 to $428. That's going up this year. So they're pretty much wiping it out. I think on the low end scale, you might gain $20.
You know,
on the higher end scale, you're going to lose money.
All they do is shuffle money around.
Oh yeah.
You know,
early retirees can earn more than they used to could. You know, remember, it used to be if you made a certain amount, I think it was $15,000 and something, and you're 62 taking Social Security. Well, you'd lose $1 for every $2 above that $15,000. That's up to $17,000 now. So, because people always tell me, no, I'm going to keep working. I'm going to take my Social Security because I heard it doesn't break even.
And at 62, 80. You're getting less money now, right?
That's right.
You're getting to that.
That's right. It used to be a 25% deduction going from full
to taking it 62.
Now it's a 26.67% deduction.
What does that do? The question I would have, you know, it was an 8% increase each year, right?
Mm-hmm. Simple interest.
Are they going to? Yeah. Are they going to accelerate that now because it's a lower number?
No, I doubt that.
Right.
Probably less than 8 now.
Right.
Yeah.
Okay, just wondering.
Because what they've done is this year is the first year they started going up. Now the full retirement age is going to be in the 66 and months.
Right. Yeah. Well, each year.
For us, we're in our 50s to 67, right?
Yeah.
But right now it's gone up from 66 and starts going up 66 in 2 months, 66 in 4 months, stuff like that. Remember they said they were going to do something about Social Security not being taxable? No, that's not the case.
Yeah, that didn't happen.
Once your income tops $34,000, you'll pay income tax on 85% of the benefits. Somebody thought they were paying 85% of the tax. It's 85% of your Social Security you're receiving.
Yes, it's not. You don't pay 85% back of what you got.
No.
That's like income brackets, just a real side deal. Most people don't realize you only get taxed on the bracket you're in as you go through it instead of the full amount.
That's right. You're in the 25% tax bracket. You're not paying 25% effective tax rate.
That's right.
Right. If you make between $32,000 and $44,000 in retirement, only 50% of your Social Security is taxed. Remember, they came up with Social Security and said this will never be taxed. This will be a fund we'll never touch to make sure Americans are secure. Well, they touched it immediately.
Well,
we'll never tax it, and then they taxed it.
Exactly.
So let's see what else is any kind of Medicare coverage is going up. Now the amount you have to make to qualify for Social Security is also going up. It's 4 quarters. To get a full 4 quarters in a year, you got to make at least $5,280 a year. It used to be $5,200. There's just little things that it used to be I remember it started where you had to pay Social Security on the first 46,000.
Oh yeah, they capped it.
Yeah.
Yeah. Oh yeah.
It's fun if you ever want to look interesting. Look at your Social Security statements, SSA.gov. Look at that Social Security statement and look, because it looks like, wait a minute, I made more than $46,000 in 1980. But that was just the maximum they did. Medicare and Social Security had a cap, and it was $46,000. And then they raised it and raised it and raised it. Well, now it's up to $128,400.
Means when you make $128,400, you're paying taxes on Social Security for that full amount, and then when you get past that, you get a little relief.
Yeah, you pay 7.65%.
Yeah, until you get to another hurdle, then you got FICA or something. And
what they did is Medicare is gone forever. They made that unlimited. So if you want to look at your actual wages, you can look at your Social Security statement from 10, 15 years ago. Well, they started uncapping Medicare. Also, don't forget, if you make over a couple $100,000 a year, there's that extra sweet spot, an extra 0.9 in Medicare. So you're paying the 1.65. If you're self-employed, you got to pay double. It's 15.3% if you're self-employed, plus another 0.9 if you make over a couple $100,000 a year. So you're up to about 16%. Your employer pays half of that, except for that 0.9 increase they don't pay.
Now, all you listening out there, tell me a flat tax doesn't sound good to you right now. Do you even understand all the changes and when they're effective? And they give it to you here and they take it from you there. I'm telling you, flat tax. Come on, guys, get behind me.
I think there's too many lobbyists for that.
Exactly. That's where they make all the money, lobbying on the tax code.
Well, what you'll find is a flat tax makes perfect sense to us. And it would make perfect sense to most people, except lower income, because those people don't pay any tax.
No, and you wouldn't either.
Yeah.
The flat tax wouldn't start until like 20,000.
I've seen
19,000.
But it's still what they'll do is they'll take a person that makes it doesn't start till 20. I'll take a person that makes 35, and they'll find that person wouldn't have paid for tax before. Now they're going to pay 27% on the difference between the first 20 and that. There's always a thing like that out there.
Well, there's always something.
No, I know. I think everybody should pay the dang same. You're going to pay less if you make less.
And you can get rid of all. Well, anyway, don't get me started.
Get rid of all the accountants.
Expense,
IRS
all
is gone.
that stuff. That's right.
No more.
You could unemploy 70,000 people one fell swoop. That would be nice, right? Yeah, they go over great.
Yeah. Can I throw the DMV with them too?
But just put them. You know what? If you want to enlist, we just put you in the military. How about that? Pay scale is a little different, but we'll accommodate you.
Oh, I remember when I was in the military, I was sharing a 2-bedroom apartment with another couple.
Right.
I made $400 a month.
Yeah, right.
Every time I used to hear my grandpa talk like that, I made $12 a year. I'm like, really?
Oh, yeah.
Dang, he's old. Now I'm the same way. Well, I made $400 a month. I remember part of mine, and it's terrible, but it wasn't all of it. But I remember I got an extra couple $100 if I got married. And so I'm like, hey, that's $200 extra. Plus, you get a little extra for your housing. I was like, well, maybe that. But I've been poor in the military, and I've had money. And trust me, they say money is not the goal. But it's a hell of a lot better than being poor.
Absolutely.
I want to thank everybody for listening to the show today. Remember, if you have any financial questions or you'd like to take advantage of our no-cost, no-obligation retirement plan, written retirement plan, Social Security Optimizer, or you just like an information kit, our number is 972-715-2424. Again, 972-715-2424. I'm Victor McClure for Guy Allett. We always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.